Welcome back to Financial Strategies with Andrew Adjemi in Connecticut and Daniel Adjemi in Colorado.
So in about April of last year, about a year ago now, one of our clients, Benny, calls us up and he said, "Hey, I'm watching TV here, Andrew, and Delta Airlines, the stock is just dropping, and I see that you bought me Delta Airlines. I mean, what's going on?" And it's selling for like $35 a share, and you paid like $85. And does that mean I already lost $50 a share on this? And we talked to Benny and we said, Benny, actually you're talking about two different things. And one is that, you're looking at and watching the share price, the equity, the of the company. But what we did was we bought the bond, the individual bond. And an individual bond typically sells for 100 per bond. And we bought it for $85 a bond. So we got it for a discount, Benny. And it's going to pay you 7% for every year until the year 2028. And so he once he understood the what was going on with there, and then we also explained the aspect that a bond, what makes a bond safe is the ability to hold it to maturity. When you own an individual bond, you can hold it to maturity. You get the whatever it was, in this case, 7% per year over that period of time. Then you get your money back at maturity, as long as the company is a strong and solid company. So when we explained that to him, he said, "Oh, that's great. So the risk here is not all that great." We said, "No, at this point they have great financials as far as their business risk goes and their financial risk, and everything's looking good for us from that standpoint. So that's why we bought it. We bought it at this discount." Well, as the year went on, near closer to the end of the year, Delta, it was no longer a good risk in our minds. They had spent their cash trying to stay afloat. They didn't have the passengers that were expected to be had, or what they had usually had. So they took on a lot of debt. We didn't like that anymore. We didn't like the financial risk of the company, or nor the business risk of Delta with everything going on. So we sold Delta at 105. We bought it at 85, sold it at 105, made $20 per bond on that, plus the interest over time. So we made 20 to 25% for our clients in less than a year, doing it safely or doing it with more security at less risk than the market. I'm Andrew Adjemi.
And I'm Daniel Adjemi, and you're listening to Financial Strategies. Our subject today is risky business, and we are talking about um, different types of risks that investors may not realize they're taking on. They may not know the questions to ask. And Dad, I think that story really illustrates um, insolvency risk as well as individual company risk, right? Um, if you bought a ETF that owned a bunch of stocks in it, no one's really doing the individual company risk analysis of those, because you're saying, I'm just going to spread my money across all these different companies, and if one goes bad, that's okay. A lot of fund managers, they have to either buy like a company based on how big of a market cap it is or how small of a market cap it is, so they buy it when it gets bigger. So like, for example, this whole GameStop thing, right? The market cap got so big, fund managers had to buy that even though they didn't want it. Their analysts were saying, this is garbage, don't put it in the fund, but their mandate was to buy it because of how big the market cap got. And then what does that do? That drives the price up because more people are going in. Now you got this piece of junk in your company that's insolvent, right?
Right.
Or,
In your
or
mutual
close to
fund. Yeah.
insolvent.
Yeah.
Um, and you have to buy that because your mandate is
It's
to
meant,
buy
right.
market caps that are this big, right?
Right.
So when you have someone doing the the analysis on the actual cash balances, the income, you're looking and doing a deep dive on the money. What you can do is you can even go lower or higher into the capital structure. And what that means is, if Delta went out of business, the equity holders, right, the people who own the stock, get completely wiped out. Their money goes away. And then the bondholders become the owners of the company, and they get to
Nice.
make the decisions of what's going to happen with the company. So they'll say, okay, we're going to restructure the company and now we'll become the equity holders. Or they'll say, we're going to liquidate the company. We're going to sell all the planes. We're going to sell all the property, equipment, plants, everything they have. And then we're going to pay ourselves back for these bonds we hold. So you can look and you could say, if Delta liquidated everything, these bonds would be worth par 100, and we're buying it at 80 to 85. So our worst case scenario is they go bankrupt, we collect dividends until they go bankrupt, and then they liquidate everything, and we collect that, $15 a bond. Pretty good. Pretty
Yeah.
good when the world's falling apart. People forget how
Right.
scary that was in COVID. But what happened actually was, and then normal case would be they don't go bankrupt and we just hold it until maturity and get 7% a year. But then what happened? We got best case scenario where the government said we're just going to give you money, and in less than a year, those bonds came up over par, while the balance sheet of the company, right, got weaker.
Yeah.
So now the risk of the company, even though it felt better because people always want to buy things high, it felt better because the price came up, but the value, the solvency, right? That's one of your things. The solvency of the company, the risk, the individual company risk actually went up, or it was more
Right.
likely for them to have problems, even though it didn't feel like that because the share prices were coming up, the bonds were coming up. So we took our profits, we collected our dividends for our clients, we got out of that, made a really nice return, and we're ready to move on into the next thing. We call that finding companies that have the wrong price tag on them, right?
Nice. Buying low, selling high, right? Daniel, when you talk about it, what I'm reminded of is the aspect of, another risk that people run into is lack of diversification. I'm sorry, that is one of the risks, but what I want to say is lack of customization. Because you're talking about these mutual funds that they have to buy this company, like GameStop, because it's written into what the types of companies that they have to buy. There's no customization there with that. And when you have people who are customizing a portfolio for you to be able to do what you want it to do, because we're all individuals, right? And so we all drive different cars, dress differently. Look at this. I'm wearing a bow tie. You got open collar there, right? And we're all different, right? I mean, we look alike, but we're different, right? But from that standpoint, we're all individuals, so we need to have things customized. At least, too many times there's cookie cutter approaches, and this person fits in this part, this person fits in this one, this person fits in this one, and that lack of customization is a risk as well. Do you agree with that concept?
Yeah, I do. I do agree with that. And I think to dive a little deeper into that, that's why we're having this conversation, because when you do that cookie cutter and you don't do the individual analysis, you don't have that customization, then what ends up happening is we go right back to the first story with the bike, where it's just, this is a bike that works for everything that it doesn't work for, right?
Right.
And they don't say, well, if you're going down a hill, you need to upgrade these brakes because
Right.
this is customized. This is what you need. And you
Right.
have to have that conversation about like the cleanest dirty shirt. I don't want to take this type of risk. Pick the risks that you want to take. Some people have different things. So some people might say, I don't want to lose my purchasing power. So they should not have money sitting in cash or in the bank. Some people will say, I don't want to be involved in this market melt up, right? So
Right.
they should not be in companies like GameStop. But unless you have those conversations and then it can be customized, not just buying a fund that buys things that it's mandated to buy, you're absolutely right with that customization, but it's a conversation based on you, and you have to spend the time to dive in and find out what the risks are and which ones of them you want to take on.
Right, exactly. And that's why today's show is called Risky Business. We want you to understand the risk that you're facing and make sure that you're invested in things that are only taking on the risk that you want to take on. Well, this time is just going by so quickly today. It's time for us to take another break. And I want to let you know in our listening audience, we have a white paper. We have a report to give to you today that's called The Importance of Financial Defense. And defending your portfolio can help you protect your portfolio and be careful of the risks that you're taking. So we want to put that in your hand if you'd like that. Importance of Financial Defense. And also the book, Financial Insanity. This is all financial insanity going on in the world today with all these the different risks that are facing us more than ever when it comes to our money. We work too hard for our money to be losing our money. So we got Financial Insanity written by David Scranton to the next 5 callers. And all we ask in return is to be able to have a 10-minute conversation with you about the book once you finish reading it. So you can have the book, Financial Insanity, or the white paper, Importance of Financial Defense, by calling 800-725-7616, 800-725-7616, and ask Megan for those books, for the book or the white paper. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com.